Hi everyone, this is Anders Ibsen with Windermere Professional Partners, managing broker of Anders Ibsen Homes. Now, like most people, you probably have questions about where the market is heading. How is it going to affect me? And probably more pointedly, are we heading into a recession? And what might that mean for my bottom line? Now, there's a good analogy for this. It was actually spoken by the famous hockey player Wayne Gretzky. He said, "When I hit the puck, I don't aim for where it is, I aim for where the puck is going." And that's a good analogy for markets. Now, no one can predict what interest rates are going to be next spring, for example, but we can get a pretty good picture about what the facts on the ground are right now and how we can best forecast a plan that helps you. So how is today's market fundamentally different than the old market, which we'll define as the start of 2022? For starters, days on market. During the time when interest rates were reliably at 2 to 3%, everyone knew that bidding wars were common. You could put a home on the market as long as it was reasonably priced. Within that first weekend, you would get multiple offers pretty reliably. Now, here in Tacoma, for example, your average time on market has nearly tripled to where 2 to 3 week listing periods are now the norm, and sellers are dropping prices pretty consistently as well. But you're probably thinking about price and value, and here's where it gets interesting. So as of now, the median Pierce County home price is about $525,000. To give you some perspective, the median Pierce County home price at the start of the year was $525,000. So what we're really looking at is less of a declining market and more of a stabilizing market, where the crazy appreciation that we saw due to those bidding wars is really starting to tamp down, and we're basically seeing kind of a status quo in the market. But what about recessions though? How is that going to affect me, and what will that do to prices? Well, it's interesting you ask that because recessions are actually pretty normal. All a recession is just 2 quarters of negative GDP growth, and depending on how you measure them, we've had one maybe 6 or 7 times in the last 40 years. And now I'm actually going to do a little something different. I'm going to pause this video and give you a little bit of a pop quiz. So out of the last recessions that we've had, the 1970s stagflation, the 2 80s recessions, the dot-com bust, the housing crash, and depending on how you measure it, COVID, which technically was a recession for a while, out of all those recessions, how many of them actually crashed home prices? Take a few seconds and think of your answer. Time's up. And the answer is just one. Only one recession out of the last 40 to 50 years actually crashed home values, and that was the 2008 crash caused by housing. And in particular, it was actually caused by fraud among institutional investors, predatory lending, and other factors, but it was largely something that initiated within the housing sphere. What you tend to see with most recessions is a leveling. What you may see is somewhat of a dip in housing prices, but usually by the end of the recession, home prices usually level off or even slightly appreciate. They just kind of ride the consumer price index. So houses are not stocks. They don't have peaks and valleys in their prices. They don't have the same kind of volatility because it's a lot harder to sell a house than it is to sell a share of a company. Think of housing values more like a staircase, where there are periods of appreciation and leveling ad infinitum. For housing prices to really crash, what you need to see, just like anything, is a fundamental change in supply and demand. Supply would dramatically have to increase for prices to really drop the same way they did back in 2008. So what would the major factors be if that were to happen, if we had a recession and your values tanked? Let's look at a few possibilities. Consider, for example, new construction. What if there's a massive uptick in new homes and condos that are being built? Of the possibilities, that's the least likely because builders have to sell the things they build. And as conditions have cooled, builders are having somewhat of a harder time. Not to mention their profit margins are really dipping because labor and material costs are increasing due to inflation. What about foreclosures? If there's a recession and people fall behind on their bills, lose their jobs, won't there be just a big glut of bank-owned homes flooding the market like in 2010 or 2009? Not necessarily, because unlike 2007, when everyone got a loan just by stating their income, it's a lot harder to get a loan, and consequently, due to the appreciation that we've had over the last several years, your average homeowner is equity rich. The average American homeowner actually has about 50% equity on average in their home, and here in Washington State, it's actually a little bit higher, about 55%. So even if people do fall on hard times, maybe lose a job or something bad happens, they're not necessarily going to get repossessed. They'll probably just end up selling. And while that's definitely not something to celebrate, they'll still have some money in their pocket that they can use to move on. And what that means for you and for the market is that it makes the idea, the notion of bank-owned homes flooding the market and driving down prices a lot less likely than what we've seen in that particular recession. Third and finally, this is the most important reason why it's not very likely supply is going to rise considerably, is interest rates, but from the other end. So consider the major appreciation that our market experienced over the last few years. What a lot of homeowners did, myself included, was refinance their home back when interest rates were 2 or 3%, which is basically free money. It's very low. And so what that means is, for many homeowners who don't have a hard reason why they have to sell, they're just going to stay put because they don't want to have to pay a higher price at 2 to 3 times the mortgage rate for their next house. So what that's going to do is suppress sales activity among people who want to keep their lower cost of living as long as they can. So for those reasons, it's very unlikely that we're going to see a major increase in supply that it would take to really dip home prices. So just looking at the facts, what looks the most likely is we're just going to see a continued kind of status quo, where home prices maybe level off, maybe mildly appreciate along with the consumer price index, but don't substantially appreciate, but don't substantially dip either. Normalcy and balance seems to be the most likely future for some time. But enough about markets. How does that affect you? Let's say that you do have to sell your home. What do all these things mean for you and what you should be doing? Well, the first thing is recognizing that the fundamentals of selling are more important now than ever. And these take many different forms, but probably the most important thing that you and your agent have to look for is time on market. Time on market is really important for evaluating your listing strategy because it informs you what winning looks like. For example, in some neighborhoods, your average home is on the market for maybe 2 weeks before it's under contract. Some different price ranges or neighborhoods might be considerably longer, maybe 30 or 40 days. Understanding time on market lets you know how you're doing, along with looking at other analytics like how many showings you're getting, buyer feedback, and other factors. So being conscious of that, because this is no longer a time when you can just list your home on the market and the first week you'll get multiple offers, understanding those facts on the ground has never been more essential. But besides reading data generically, the expert that you hire should also understand the specifics. For example, how do closed sales and different kinds of listings give you the best idea about how you should price your home? Closed sales, for example, are usually held up as the gold standard for determining what the value of your home might be. They're great because they closed. A buyer and a seller agreed on the price and it succeeded in closing, and that's a comp. As both a realtor and an appraiser, those are usually things that I place a great deal of weight on. The caveat, though, with closed sales is they're in the past. Let's say you found a perfect comparable home that's just like yours, but it sold in the summer, and you're thinking of listing maybe in the winter or maybe later on next year. What changed between the summer of 2021 and now, fourth quarter 2022? What rate difference was there and what difference was there in buyer demand? That's an example of a factor you should keep in mind. Another point of data is what are called pending listings. You're going to hear the word pending a lot. What that means is a listing that went on the market, it hasn't yet closed, but a buyer offered on the property and the seller accepted, and the sale is pending. They are working towards closing. Pendings are great because that's the current market. That offer might have come in 1 to 2 weeks earlier, and so that number that they've agreed to is very recent. The issue with pendings, besides the fact that they have not yet closed, is you don't know what they're under contract for. It could be the list price, it could be higher, it could be less, so some investigative work is definitely in order. And finally, this is something sellers look at the most, but you should actually be the most skeptical about, is active listings. A lot of people do that, surprisingly. They play on their phones and look at listings in their neighborhood. And why that can be problematic is that sellers can list their home for whatever they want. It's not necessarily reflective of market value, which is what a buyer would pay. But in your pre-listing strategy, active listings can actually be quite useful because, most importantly, they allow you to avoid other sellers' mistakes. Returning to the example of a home just like yours, let's say you found an active listing, and in your neighborhood, the typical home in your price range, let's say it's off the market on average in 2 weeks. and this particular active listing has been on for over 40 days. So we can probably infer that if this home, which is a model match just like yours, has been on for far longer than the norm, we can probably conclude that their price is wrong, and then you should list more conservatively. So that's a good example of how you can use other sellers' mistakes to your advantage for making sure you not only get top dollar, but you can minimize your stress. Other factors include just understanding supply and demand, and in particular, is the supply and demand that we're looking at comparable to your home? For example, if you're selling a condominium, we're not going to look at single-family home sales. If we're selling a home that's on waterfront, we're only going to look at waterfront homes, things like that. You want to make sure that you're measuring the ratio of pending listings to actives so you can have a good idea of what the demand is for your kind of product. And we're keeping in mind factors like price range and other very material statistical data to make sure that we're comparing apples to apples. Condition has a very outsized influence in cooling markets because, simply put, buyers have more choices. Buyers are going to be much more critical of blemishes, deferred maintenance, or datedness, and making sure that you're aware of the impact that condition has on the value and what improvements might be economical are certainly much more important now than they were when listings were in short supply. Finally, occupancy. Occupancy is something that is less talked about than it should be as a pre-listing strategy, but the fact of the matter is who is living or not living in your home has a profound influence on how much money you're going to make and how long it's going to take to sell your home. Generally, the gold standard is if your home is vacant and professionally staged. One, because it's going to be a lot easier for buyers to show it, and two, it's going to look amazing online. It's going to look less like someone else's house and more like the buyer's house in their own mind. Whereas on the flip side, by far the hardest kind of home to sell is one that's occupied by a renter, because most buyers don't want to be landlords and because showings are going to be a nightmare for that house. So factoring in the impact of occupancy on your goals relating to listing your house is more essential now than ever. Fundamentally though, it really goes back to time on market, number of showings, and what buyers are saying, because for your purposes, time is literally money. Generally what we're seeing is that the longer your home is on the market, the less it's going to sell for. Usually your best probability of getting a strong full-priced offer with reasonable terms is usually within the first 1 to 2 weeks of hitting the market. Any longer than that, and more than likely you're going to have to drop the price to attract any buyer at all. And if it goes on the market even longer than that, and your listing becomes truly stale, then any offer you do receive is probably going to be lowball, and they're probably going to use the inspection and other contingencies to come after you. So for your purposes, time is literally money, and it's a factor that we have to make center stage. Finally, a question that's very common is seasonality. Is there an ideal time of the year to sell? Should I wait until the spring, for example? Should I sell now or later? And the answer, which may surprise you, is that seasonality is actually a highly overrated factor when listing a home. Let's look at the facts for right here in the North End. So back in the summer of 2021, back when interest rates were around 3% on average, very cheap, your average North End home had about a 151% chance of selling, meaning that there were way more pending listings that were under contract than were actively listed. It was a great time to sell then. Contrast that now to 2022 and the summer that we just had, and the chance of selling for the same house dropped to just over 80%, so a 60% drop in selling. You actually had a significantly better chance of selling your home favorably in December of the prior year than the summer of this year, just because of how different interest rates were and how much more buying power buyers had. So it's less about waiting for some arbitrary time of the year or some kind of arbitrary timeline to sell your home, and it's more about just working with your professional to understand what the current market conditions are now and do they work for your goal. Just like Wayne Gretzky tells us, aim for where the puck is going. Look at those facts on the ground, look at the market statistics, make an educated judgment based on, in the short run, where do you think those are going to go, and just align them with your goals and see if that makes sense for your own situation. So as you can see, there's a lot of subtlety, nuance, and detail to selling a home, especially in a changing market. So working with a local expert who not only understands the market and has done a fair amount of work in the area, but ideally someone who lives here and experiences the same things that you do, I would say is more important now than ever. Whether you're thinking of selling or you just have questions about what market conditions might be now or in the future, I'm always happy to take your calls, texts, or emails. Thank you so much for watching. Have a great day and have a very Merry Christmas too.